You've probably seen the headlines everywhere, right? The S&P 500 just smashed through 7,000, a huge historic milestone. But here's the thing, that celebration is hiding a pretty brutal truth. While the market looks stronger than ever on the surface, a quiet earthquake is cracking its very foundations. So let's get into it.
Right, so here's the big question, the paradox at the heart of everything right now. How can the market be at an all-time high while some of the biggest, most famous tech companies are actually bleeding? The answer isn't just about stocks. It's about a massive shift in the AI gold rush, a change in the rules of the game that has totally blindsided Wall Street.
And there it is. That's the magic number, 7,000. But while the champagne corks were popping for the overall market, a really quiet and frankly vicious rotation of capital was happening underneath. See, investors weren't just tweaking their portfolios, they were starting a financial earthquake, selling off some tech giants and piling into a completely new breed of winner. And that's why we're calling this 7,000-point record a total mirage. You know that old Wall Street saying, a rising tide lifts all boats? Well, you can forget it. It's officially dead. In today's market, you're either in the right boat or you're sinking, and fast.
Okay, so let's cut through the noise here. The headline you're reading is record growth, but the reality on the ground is a brutal rotation. We're in what you could call a two-speed market, where a tiny handful of winners are making everything look great while masking some really deep losses elsewhere. Understanding the split is the key to, well, everything that's happening right now.
So what's actually driving all this? Well, in one word, AI. But, and this is a big but, not in the way you might think. See, the market has completely changed the rules. It's not about spending on AI anymore, it's all about earning from it. And we're calling this the Great AI Rotation. You know, for the past couple of years, the whole conversation, the only question that mattered was how many NVIDIA GPUs are you buying? That was the training era, where just building massive AI infrastructure got you rewarded. Well, guess what? That era is dead. The new question, the only one that matters now, is how much actual cash is your AI generating? Welcome to the inference era.
And this is maybe the single most important idea you need to grasp about the market today, the inference era. It is all about proof. The market is tired of hearing about what AI could do someday. It's over the promises. Now it's demanding to see the receipts for what AI is doing for the bottom line, right now. So this new era, it's basically split the tech world right down the middle into two very distinct camps. You have the AI earners and you have the AI spenders. And the difference in their fortunes, well, it's creating a pretty dramatic tale of two very different strategies.
And look, the undisputed champion of the inference era, the king of the earners, is Meta. While pretty much everyone else was out there selling the future of AI, Zuckerberg's company was quietly showing the world how to make it print money today.
I mean, just look at these numbers. Ad reach is up a whopping 22%, and that's because their Llama 4 AI is a ridiculously efficient ad salesman. But here's the real kicker. Even while they were spending billions on new infrastructure, they still hit a 38% operating margin. Meta showed everyone that AI doesn't have to be just a giant money pit. It can be a profit engine, right now.
Okay, so on the other side of the fence, you've got the big spenders. We're talking about giants like Amazon and Microsoft. They are investing absolutely colossal sums of money into AI. But the market is starting to get nervous, and it's asking a pretty simple question. When are we going to see a return on all this cash?
Get ready for this number, $200 billion. That is the potential CapEx expenditure or CapEx runway for Amazon alone. And when investors saw that number, they basically had a heart attack. It represents a massive, massive amount of digging without a clear sign of gold just yet. And the market is losing its patience with endless spending.
So this really sums it all up, side by side. On one side, with Meta, you have a focus on AI as a profit center. The key metric is operating margins. And the investor reaction? A reward. On the other side, with Amazon and the like, AI is still being treated as a cost center. The key metric everyone's watching is CapEx. And the reaction is, you guessed it, fear. This is the fundamental split driving everything.
So you might be asking, how are the winners, these earners, pouring gasoline on the fire and amplifying their success? Well, they're using this powerful financial weapon that the spenders simply can't touch right now. It's called the buyback yield. Now, a buyback yield, it's one of the loudest, clearest signals a company can send. It's basically a declaration that they are generating so much cash they can fund all their operations, all their R&D, and still have giant piles left over to return to shareholders. For an investor, it's the ultimate "we believe in ourselves" statement from the company.
Okay, the easiest way to think about this is the pizza analogy. Stick with me here. Imagine your ownership in a company is one slice of a 10-slice pizza. The company then uses its profits to buy back 2 of those slices from the market and just gets rid of them. So now there are only 8 slices of pizza left. Your one slice hasn't changed, but it's now a bigger piece of the entire pizza, which makes it more valuable. Simple, right? That's a buyback.
So when a company does a big buyback, this is what they're really saying to the market. This is the subtext. It's a company shouting from the rooftops that its business is an absolute cash-generating machine, and that's a sign of incredible financial strength, especially in a world with higher interest rates.
Okay, so let's bring this all home. What does this actually mean for you? Well, it means you kind of have to throw out the old AI investing rulebook. The new game isn't about planting seeds anymore, it's about following the harvest. So here it is, your new checklist, your new rulebook for thinking about AI. First, look beyond those big headline index numbers. Second, remember, the AI training era is over. We are deep in the inference era now. That means your job is to separate the spenders from the earners. How? By demanding to see the receipts, the proof of profit. And above all, follow the cash. That buyback yield will show you who's really winning.
And that really leaves us with one final, crucial question to think about. The honeymoon phase of AI is officially over. The time for just planting seeds and promising some amazing future crop is done. The market is now rewarding the companies that are actively harvesting. So you have to ask yourself, in this new AI economy, are you backing the planter or the harvester?